Hello everyone and welcome. My name is Kura and I'm a senior tutor here at NextGen Accountants. Thank you for joining today's session. This is a demo lecture on chapter 1 of ACCA Audit and Assurance, Introduction to Assurance. Whether you are just starting to explore ACCA or you are already partway through your studies and looking for a stronger foundation, I think you will get real value out of the next few minutes. So let's get straight into it. Before we touch a single definition, I want to ask you a question. Why does assurance and audit specifically actually exist? Because if you understand the why, everything else in this chapter and honestly everything else in this entire module becomes far easier to remember. Think about a very small business. A single person owns it, and that same person runs it. If that owner wants to know how the business is doing, they just look. They know because they are right there every single day. There is no gap between the person who owns the value and the person who controls it. But now think about a real company, the kind we studied for this exam, a public company, or even a reasonably large private one. The people who own that company, the shareholders, are very often not the people who run it day to day. The people running it are the directors. And here is the problem. Directors and shareholders don't automatically want the same thing. Shareholders want the value of their investment to grow. They want strong dividends. They want the share price to rise. That's what they are in it for. Directors, on the other hand, are often rewarded through salary, bonuses, and performance related pay. And what triggers a lot of those bonuses? Obviously, it's reported profit, hitting targets, looking good on paper this year, this quarter. So ask yourself, if a director is under pressure and there is a way to make this year's profit look a little stronger than it really is, whose interest does that serve? Not necessarily the shareholders, possibly just the director's own bonus. That gap between what directors want and what shareholders want is called the urgency problem. And once you see it, you cannot unsee it. It explains an enormous amount of what we studied in this entire module. So what do shareholders do about it? They can't personally check the books. They are not there day to day. What they need is an independent third party, someone with no stake in the outcome, to look at what the directors have produced and say, with a reasonable degree of confidence, whether it's actually accurate. That, in one sentence, is why audit exists. It exists to close the trust gap created by the urgency problem. Everything we are about to cover in this chapter is really just the detail underneath that one idea. So let's define assurance properly now that we know why it matters. Assurance is an engagement where a practitioner, thus the professional doing the checking, obtains sufficient appropriate evidence and then gives a conclusion designed to increase the confidence of the people using that information. In plain terms, assurance means someone independent looks at something and tells its users how much they can trust it. Every single assurance engagement, no matter what kind, is built from the same 5 elements. I want you to know these called because they get tested directly and repeatedly. First, three-party involvement. The practitioner doing the work, the intended user relying on it, and the responsible party who actually prepared the subject matter. Second, appropriate subject matter, the actual information being looked at. Third, suitable criteria, the standard we are measuring that subject matter against. Fourth, sufficient appropriate evidence, enough good quality evidence to actually support a conclusion. And fifth, a written report, the actual output expressing that conclusion clearly. Memorize those five. They will come back again and again throughout this module. Let's make this concrete by applying it to two different examples side by side. An audit of financial statements and a review of a cash flow forecast. Notice the practitioner changes name from auditor to assurance provider. The user changes from shareholders to a lender, but the underlying five element skeleton never changes. That's the pattern I want you to internalize. Now, audit is the most famous type of assurance engagement, but it is absolutely not the only one. Reviews of financial statements, systems reliability reports, social and environmental verification, reviews of internal controls, value for money audits in the public sector. All of these are assurance engagements too. And regardless of which type you are looking at, the provider always has to follow the same general principles: comply with ethics, apply professional skepticism, agree the terms upfront, gather proper evidence, document it, and reach a clear supported conclusion. Now, before we go further into the chapter, I want to take 30 seconds to tell you something because I think it's genuinely relevant to what we have just covered. We have just spent a few minutes on five elements that most students find easy to read, but surprisingly easy to forget under exam pressure. That's exactly the gap next gen accountants exist to close. Here is what studying with us actually looks like. You get one-on-one tutor support, so when something doesn't click, like it might for some of you right now on this exact topic, you can ask a real tutor directly, not just search for an answer alone. You get live interactive lectures like this one, but for the entire syllabus, where you can ask questions in real time as they come up. You get access to an online exam engine, so you are practicing on an interface that actually feels like the real ACCA exam, not just reading passively. And you get full online study materials, structured notes, question banks, and mock exams, all in one place, so you are never hunting around for what to study. If any part of today's session has been useful to you, I would genuinely encourage you to look into what a full course with us looks like. Right? Let's get back into the chapter. Let's talk about how much confidence and assurance engagement actually gives you, because it isn't all or nothing. A reasonable assurance engagement, an audit being the classic example, involves thorough procedures, tests of controls, substantive testing, real depth. It gives a high level of assurance, and the opinion is weighted positively. In our opinion, the financial statements give a true and fair view. A limited assurance engagement, a review being the classic example, involves far fewer procedures, mainly inquiry and analytical review. It gives a moderate level of assurance, and the wording is deliberately negative. Nothing has come to our attention to suggest the statements are not fairly prepared. Notice that phrasing carefully. It's not an accident. A limited assurance report is never going to say we confirm this is correct. It says we found nothing wrong, which is a genuinely weaker claim, and that difference in wording gets tested directly. Let's zoom in specifically on the external audit, since that's the center of gravity of this entire module. ISA 200 tells us the purpose of an external audit directly: to enhance the degree of confidence of intended users in the financial statements. The auditor does this by forming an opinion on whether those statements give a true and fair view, and whether they comply with the applicable reporting framework. And that phrase, true and fair, is worth pausing on. True means factually correct, consistent with accounting standards and underlying records. Fair means clear, impartial, and reflecting the real commercial substance of what actually happened, not just the technical letter of a transaction. Let's connect this straight back to where we started. Shareholders provide the money but don't run the business day to day. Directors run it on their behalf. Those directors have to prepare financial statements reporting how the company performed. And because directors have real incentives to make that performance look better than it is, an independent auditor is needed to check that what's been reported is actually true and fair. That's the whole chain in 5 steps, and it's the same agent's problem we opened with, just spelled out formally now. Even where an audit isn't legally compulsory, plenty of companies choose to have one anyway because the benefits are real: higher quality, more reliable information, independent scrutiny that's genuinely useful to management too, a deterrent effect against fraud and error, enhanced credibility with lenders and tax authorities, and often the surfacing of control weaknesses the business didn't even know it had. Now, I want to be honest with you about something important because ACCA tests this constantly. Audit does not promise everything people assume it does. This mismatch between what people think an audit guarantees and what it actually guarantees is called the expectation gap. People often believe the auditor checks every transaction. That's false. Testing is done on a sample basis. People believe the auditor will catch all fraud. That's false again. The auditor gives a reasonable assurance, not a guarantee, or not absolute assurance. People believe the auditor prepares the financial statements. It's false. That is entirely management responsibility to ensure that financial statements are free from error and material bias. And beyond the misunderstandings, there are genuine, honest limitations too. Financial statements involve real management judgment and estimates. Evidence is often persuasive rather than fully conclusive, and only a sample gets tested. Reasonable assurance is exactly that: reasonable. It is not absolute. Let's widen the lens slightly now. beyond just the audit itself. Where a company isn't legally required to have a full audit, it might choose a review instead. A review is limited assurance, not a reasonable assurance. It's built mainly on inquiry and analytical procedures rather than deep testing, which makes it less costly and less disruptive. But it also gives the user meaningful less confidence than a full audit would. Let's now put some proper vocabulary underneath everything we have discussed so far. When a company incorporates, it creates a legal split between the people who own it and the people who run it. Accountability means being answerable for your actions, open to being challenged or sanctioned. Agency is when one party, the principal, employs another party, the agent, to act on their behalf. Exactly the relationship between shareholders and directors. Stewardship is the responsibility to take good care of resources entrusted to you. And a fiduciary relationship is a relationship of good faith, precisely the kind that exists between directors and the shareholders they serve. Every one of these words is really just formal vocabulary for the same relationship we opened this lecture with. And it's worth remembering that shareholders aren't the only people reading financial statements. Employees judge whether their pay is fair. Those charged with governance assess whether reward has been balanced properly. Customers judge financial strength before committing to a long-term relationship. Suppliers and lenders assess stability before extending credit. And government checks compliance with tax and law. Audited financial statements serve all of these groups, not just shareholders alone. Let's bring this all the way back to where we started. Assurance exists because of the agent's problem. Directors and shareholders don't always want the same outcome. Every assurance engagement, whatever form it takes, shares the same five elements. Reasonable assurance and limited assurance sit at two different confidence levels, and the report's wording tells you which one you are looking at. Audit has real honest limitations. It was never designed to be 100% guarantee, and underneath all of it sits the concept of accountability, agency, and stewardship, which is really just the formal language for the trust gap we opened with. That's chapter 1 of Audit and Assurance covered. I hope it's given you a genuinely solid foundation, not just a list of definitions to memorize, but an actual understanding of why this subject exists in the first place. If you found today useful, I would love for you to consider studying the rest of this syllabus with us properly. As I mentioned earlier, that means one-on-one tutor support whenever you are stuck, live lectures across whole syllabus, an online exam engine that mirrors the real thing, and complete study materials in one place. We build NextGen because we know exactly how much of a difference proper support makes at this level, and we would genuinely like you to be part of your journey to qualifying. Thank you so much for your time. If you have any questions, please ask them now, or reach out to us directly through our website or WhatsApp.